Welcome to EduBlush. Today we are going to look at accounting grade 12, the topic inventory valuation. We are going to look at the different method of evaluating inventory according to the KEP syllabus. Okay. Now we are going to look at the three different methods of evaluating inventory, which is a weighted average, FIFO, and specific identification method. Normally, businesses want to determine the value of the stock, and they usually buy those stocks at various prices, depending on the season of the year or the time of the year. So we are going to look at this different method and how they will impact also on their profit. So now we are going to start with this to look at the stock valuation method. Specific identification. When valuing the closing stock, the stock will be at the exact cost that the price were bought. We look at specific identification, for example, someone selling cars. You know that you have Toyota, you have Mercedes, you have BMW. So you can easily identify each of those stock with their original cost. But now, when it comes for the FIFO method, the prices of the stock changes as time goes on. Things that you buy in January can become more expensive in March and more expensive in October. So that you see that the purchase price or the cost price of good changes. And as the cost price of the good changes, it also affects the value of your closing stock. Then with weighted average method, you don't look at how much the different goods were bought, but you just look at the average price, which means you look at goods that their prices, they don't change much during the year. How will that impact on the gross profit? With specific identification method, the gross profit will be as it is, okay? But now, when it comes now to the FIFO method, you see that the gross profit will be higher than the gross profit of weighted average method in the current financial year. And weighted average method, the gross profit will be lower. The reason because the value of your closing stock also changes. So we are going to look at the specific identification method, which is the simplest method of evaluating inventory. So with this specific identification method, you normally just look at each of the goods and you identify their cost with it. Okay, now look, for example, when you have different type of cars, you can have a red Ford that was bought at the beginning of the year for 100,000, and during the year you buy another white Ford for 130,000. So you can easily manipulate the price by recording the cost price of 130 so as to manipulate the profit. So that gives a disadvantage to what? To the specific identification method, because we are looking at the same type of cars, but they were not bought at the same price. So now let's look at how it is being examined. We are going to take our example from the November 2016 examination. The question says, Matrix Trader sells three different types of laptops: Lexus, Granite, and Vision. They use the periodic inventory system and specific identification method to value the stock. 1. Explain the following valuation method: FIFO. The word FIFO, first in, first out, which means the stock that were purchased first will be the stock that will be sold first. Specific identification, which means each of the goods, they are identified with a specific cost. Now let's look at this trivial calculation here. They say calculate the cost price per laptop on the 1 of October. Here you look here, opening stock, the 1 of October 2015. So if we look here, the unit, we have 118, and then the value, we have 413,000. So which means we bought 118 units for 413,000. So if we have to look at the cost price for each of them, we look at the money we spend, 413,000 divided by the number of units purchased. So that is going to give us 3,500 rand each. So there we are done out with question 1.5.1.2. So the next one says 5.1.3, calculate the value of closing stock. The value of closing stock. So closing stock means we look at the remaining stock. Now let's look at our question here. We see that at the beginning of the year, they have Lexus, and then the purchase and return. Purchase December, you look here at December 2015, they purchased granite 410. So opening stock, Lexus 118 units, and the value is 413,000. Now we come to the purchases. We have granite, 410 of them, which has a value of 1,537,500, which means each is 3,750. Then we purchase also Vision, which have a value of 630 of them, 630, which give us 2,929,500. Okay, but now we have to return some of them. We return back 20, so we are left with 610, and those 20 were for 93,000 for the Vision. So actually for Vision, we'll return this 12 minus this 3, 2. Okay, now we continue down. Continue downward. It says, now we look at sales. Sold Lexus 118 means we are left with 0. Okay, we come now to the granite. We sold 356 was sold, which means we are left with what? So we had 410 minus 356. That will give us 410 minus 356 will give us 54. And what was the price for each of them when we put them? Go ahead, look at the closing stock times 4,650. That gives us 202,500. Now we come now vision. Here is where the trap is. Originally, you know that they were 630, but actually you return 20 and you are left with 610. Now, what did you sell from the vision? You sold 502. What are you left with? So if you take your 610 minus 502, then you're left with 108. Now you multiply by the unit cost of the vision, which was 650. So if we do our calculation very fast, if we do our calculation, here, we see 108 108 divided by multiply by multiply by multiply by 108 multiply by 4,650 50. They give us 502,200. So now we have the value of our closing stock. We add it to what we already had on the granite, which was 202,500 plus 202,500. Now you can all see there it is 704,700. So we've comfortably calculated our what? Value of closing stock. Now the next method of stock valuation, which we are going to look at, we are going to look at the FIFO. The FIFO method, very simple and easy. As we said, the stock that were first bought in are the ones that are sold. So you sell the good in the order that you bought the stock. And this system can be used for any type of business that you have. So the trader that stock product do not have a long shelf life will preferably use this method. Okay, and this method is good because the prudence concept is applied because you are actually valuing the closing stock at the price of the good at the end of the year. So now let us look at an exam type question on this. So we go now to this, look at exam type question taken from February, March 2015. Yankee Electronics sells LCD flat screen television. The business is owned by Jane Yankees. As she has other businesses to run, she cannot be at the shop very often. She employed Maureen Miller to run the shop for her. The business uses periodic inventory system and the first in, first out method. Periodic inventory system, which means at each time you don't calculate your cost of sale each time a sale is made. You only calculate it maybe after a certain period of time. Okay, the first one says, calculate the value of closing stock of 145 television set on the 28th of February by using the Fifo method. So now we have to go now down to the information, value of closing stock. We have 145 television left. We have 145 TV left. What is the value of the closing stock? For us to use FIFO method, we have to look at say, okay, here we started with 70 television. The unit price was 5,000, which gave us a total price of 385,500. Now we look at purchases. This was opening stock. Now let's look at purchases. First, we buy 150 units for 5,000 rand each. But now what comes in? There is a carriage of 18,750 for this 150 unit, which means now we have to now do what? We have to look at the value for the carriage for each of the units and attach it there. Excuse me. So we see now that if we attach, we take this 18,750 divided by 150, then the price of each of these is going to increase. So we see now that it's going to increase to 5,125, means each of them have a value of 125 added to it just because of carriage. So that gives us our total of 768,750. Then in August we had 120 that was purchased for 4,750, but we also have a carriage there for 15,000. This 15,000 will divide it by 120 to have know what each unit. So this will increase our unit price to 4,875. For those of you who don't understand, it means if I take this 18,750, I divide by 150 here, it gives me 125 added. Similarly here, if I take the carriage of 15,000, I divide it by number of units, then it's going to add also my cost here. Then I purchase another unit of 90 in December for 4,450. My carriage there was 11,250. I do similar calculation divided by 90. So this now is going to increase my unit cost now to 4,575. So that means this gives me my total of 585 and 411,750. Now, very important information C. Information C is very important. Going to turn of 3 TV television from August tells us the price. In August, we bought them for 4,750, and since they are going to give us back the supplier is going to reverse the carriage, then similarly when we're doing the calculation, we have to also add the carriage there. But now what we are very important, what we are looking at now is what is our closing stock. Now we go now to the question. Closing stock, we have 145 unit left. Where does this 145 unit comes from? First, I start that it comes from this 90. the last one that were there. These 90 were bought in December. All of these 90 were left that were valued at 411,750. And then from here, from 145, we've taken out 90. What are we left with? We are left with 55. Now we go now to the next level. The 55 will come from here. Okay? So the 55 comes from there. So those 55, we are going to multiply that 55 by the value of each stock. So we are going to multiply by what? By 4,875. Why are we not using 4,750? Because remember that we are also valuing the carriage on the purchase as the value of the stock. So when we add there, that amount there is going to give us, let's do the calculation together. $55,000 multiply by 4,875. That gives us 268,125. So if you add the sum of these two, it's going to give you 679,825. I hope 875, yes, 875. So now we have calculated the value of our closing stock. So what you see here that is very, very important is that you don't forget to put the carriage on when you are going to the next unit, because we're using first in, first out. So the first good that we bought were sold. So the closing stock will be the last good. That's why I started with 90 and I used the 55 here. Okay, now we're going to look at the next question, which says calculate the cost of sales. Cost of sale. The cost, I like to say the cost of the good sold. Cost of the good sold. How much did it cost you what you are selling? So we said we are using periodic inventory system, which we are going to use opening stock plus purchase minus return, which we call now net purchase, less closing stock. So if we come back here, our opening stock here was 38,500. We go to our total purchase. Our total purchase was 1,765,500. But remember, there was this return of 3 TV sets from the August purchase. But now, very, very important, what they are telling us here is that the 3 TV sets that were being returned, we are going to recover back our transportation cost, which means we are going to value it at, from August, at 4,875 minus closing stock. The closing stock, the good on hand, which is first calculated, was 679,875. Very, very important, learners. Remember, this comes from your previous question. It comes from the previous question, 2.1.1. So you have to use this here. It's very, very important. Whatever figure you have here, you still have to use it because that is what gives your method mark. So actually, you are going to get 1,456,000. It gives you 1,456,000. Now we go now to the next. The next is calculate the average markup. Average markup. Markup is gross profit over cost of sale percentage per year. So how do we get our gross profit? It's sales minus cost of sales all over cost of sale times 100. Where do we get our sale? Come down here. We look at our total sales was 2,303,800 minus the cost of sale from your previous calculation, 1,456,000 all over the cost of sale times 100. So if you do your calculation, you have approximately 58.2%. So we've calculated that. Now we're going out to the next part of the question. Provide a calculation to prove whether the information given by the cleaner are true or not. Refer to information D. What does it say? Information D says that Jane has been informed by a cleaner that he suspects Marine of giving away television to her family. Now you see now what they're asking us to calculate is missing stock. Missing stock. We have to look at the missing stock. So we go to 2.3, missing stock. We have to look at all of our stock. Opening stock, how many units do we have? How many units do we purchase? So this gives us what is available. So we go there, we have to look at what we have available. So we started with we have 70. We purchased 360. So it should be, if you add here 40, it should be 430. But hey, don't forget, we'll return 3. We should have 427. Now we have this available, but we sold how many? If you look at how many television did we sell? Information E, we sold 276 units. So actually, we should be left with we should be left with 151 units, but we are left with 145. That's what we have now, which means 6 missing units. So actually she's telling the truth. They were still in the stock. So now we go now to the next one now. which says Jane is concerned that the final stock of 45 TV set is not appropriate for her business. Provide a calculation. 2.4 is theoretical, you have to know it. You ask yourself, how many TV did I buy and how many did I sell? So you see that I'm left compared to what was sold. Okay, then I look at how many days are in a year. So I see that I'm left with 145 and only 271, 276 was sold in 365 days, which means that I have a holding period of 192 days, which is very, very slow. This is not appropriate for the business. So the next question asks you, Jane has adjusted the selling price during the year to attract new customers. Comment on whether the strategy was good or not. Now let us provide figures to support that. We come here. Let's see if she adjusted. Let's look at the sales here. Let's focus here. Just 30 unit, 30 unit, and then you look at the December 150 units when the price was reduced. So you see that we can say that it was successful in December because much units, 150 units sold. But what happened? But sales dropped in January when the price was increased. So you see that she might have increased the price and the competitors did not increase the price. So this has actually affected her sales, which means that that strategy of increasing the price was wrong. So now we go now to the other one. Okay, now. Okay, now we have to go now to look at the next question. Jane has provide 2 points to assist Jane for internal control. Now you look, they are stealing stocks are missing. So most of you said, Jane should install security cameras. No, no, no. You don't jump to the one. Security cameras, yes, you see the stock already missing. So what do? We look at appropriate. Don't ever forget division of duties. Division of duties. You see, they're still in the stock. You see, Jane is giving it to the customers, to the family. So if division of duties to check for all sales recorded, and then secondly, you come and do regular stock counts. If Jane knows that you're always coming to do counting, then they will should avoid stealing, or you will consider the pricing policy. So now let's go to the weighted average method. Weighted average is very easy, but you learners, I know that you always say, no, it's very easy. Weighted average, we are just basically calculating the average price. So just look at, imagine that you have 10 brothers. One is 5 years, other is 8 years, other is 12 years, other is 15 years, 18 years, and so forth. And they say calculate the average age. You just take each of them their age, you join them together and divide by the number of brothers 10 that you have. So that is what we are going to be doing with weighted average method. So now let us look at how this applies in your exam. You are provided with information related to smart uniform for June 2014. The business is owned by Harry Mavuso. They buy and sell school blazers. The business uses weighted average method for stock valuation and the periodic inventory system. First, calculate the amount paid for the carriage on the purchase on the 11th of June. Yeah, that is level 1 question. So, purchase on the 11th of June. You look here, this is 11th of June for the carriage. So, what do? I come here on the 11th of June. I spend 352. So my total cost was 352,600. But now I bought 1,600 units times 215. What was my actual price that money I spent before carriage? It was 1,600 times 215. I spent 3. Okay, 344 to buy. But my total cost compared to 352,600, which is my total cost. So therefore, carriage will be the total cost minus the cost of the good itself. Okay, total cost minus the cost of the good itself will give you your carriage. So if we do the calculation together, you're going to see that it's going to be 8,600 rand. Okay, we'll move to the next question, 1.3.2. Okay, let's look at the question together. Calculate the value of closing stock using weighted average. Now, this is where it's very, very important, weighted average. I look at value, weighted average, price is equals to total value divided by total units. So if I have to look at those values, I have to look at the value of the opening stock, the value of the purchase, and minus any return. I look also the unit of opening stock, the unit purchase, and the unit return. So let us go now to our table. Values of opening stock, values of opening stock. Okay, let's go to our table. Value of opening stock 77,900. Unit of opening stock 410. Value of purchase, you see here, value of purchase 770,850. 770,850. Unit purchase 3280. And then we go again. Value of return minus the value of return. How many were returned? If there was any return, let's see. We come back here. Return 1.2, 1,200 to return. What was the value of return? 5. So if we do that, we have 847,550 divided by 3,685. Now, remember, we are looking at what? This is the weighted average price that we were looking for. So let's calculate the value of closing stock using the weighted average price method. Okay, so we've gotten the weighted average price. Okay, the weighted average price now we multiply by 580. This 580 is unit left. So these will give us 1,333,400. The next question there, very, very simple. Let's look at the next question, next page. Harry is considering to change in the method of valuing stock. The value of closing stock using FIFO will be that higher than using weighted average. You see, the value of closing stock. Let's look at 1.3.3. Explain how this will affect gross profit. Now, for us to explain, let us look at this. What is our gross profit? Our gross profit is equals to sales minus cost of sales. And this cost of sale is made up of opening stock plus purchase minus closing stock. Okay. Now, he wants to change to FIFO method. They say the value of closing stock using FIFO will be higher, which means that if you see, if closing stock goes up, the value of closing stock goes up. You see this minus sign here. This we use to calculate the cost of sale with this. So if closing stock goes up, it means cost of sale will come down. And if cost of sale goes down compared with the sales, cost of sale reducing, it means gross profit goes up, and vice versa. Okay, so if gross profit equals to sales minus cost of sales, so we see now that again we apply here. If closing stock goes down, the value of cost of sale now increases, which means this will automatically decrease our gross profit. So you see that cost of sale, increase in value of the closing stock affect also increase the gross profit. So how will this affect the gross profit? We say that what? The gross profit will automatically increase by that amount that you've seen there. You've seen from our calculation. Say once the closing stock value increases, it means gross profit also will increase. Now, one reason for changing, well, they might decide to change FIFO is suitable or accurate or unrealistic method for valuing stock of blazers because the value changes over time. And blazers are also discrete units where the cost is easily identified. So you can say, okay, it is easy method and realistic. Okay, they are discrete. Okay, and also they are accurate when prices are changing. Now, for me to be against, what will I say? I will say it's unethical. It's unethical to change just to manipulate profits. Okay, so it's also against the accounting principle of inconsistency. The principle of consistency, so you cannot compare one period to another. Okay, go to the last question. Harry is concerned about the control of the stock of blazer. Concern about control means we are looking at missing stock. We come now down here. You see the like asking missing stock. If Harry is concerned about stock of blazer, I said, okay, 1.3.4. Let me go back there. Let me look at what is available. What was available? I said opening stock, purchase minus return. Opening stock was 410 plus purchase 3280 minus return. Okay, that will give it gives me what is available, which will be compare what is available now. This is this minus that. There's my calculator. Yeah, we go together. Let's do it together. 410 plus a purchase of 3280 minus our return. So he got this. Okay, now he sold. If he sold that, he's supposed to be left with 2,900. He sold that, he's supposed to be left with 785, but he's left with 580. So missing is 785 minus the 580 that he has now left, which will be 205 missing. So I'd like to thank you all for attending the class of today. I hope you understand the three methods of evaluating inventory. For further questions and more understanding of this topic, I would like you to subscribe to EduBlush. Then you are going to see much more questions and practice on this topic. Thank you and have a good day.